Hi, welcome back to the Dummy Investor channel. In case this is your first time to the channel, this channel is all about becoming a better retail investor. I've been a retail investor myself for over a decade now, and I use this platform to periodically share my perspective on the Indian stock market, but more importantly, also talk about my fair share of mistakes that I've made and some bright spots that I've had in my investing journey in the hope that it benefits at least a few listeners out there. Now, I have skin in the game in the sense that I actively manage my stock portfolio, so I usually restrict my thoughts and opinions on what works for me or doesn't work for me, and generally avoid theoretical stuff. There are many ways to generate long-term returns, through long-term investing, and so I just talk about what works for me. There could be alternate views out there. So please do use your discretion before agreeing to anything I say. And finally, this is not a trader's channel. And this is primarily for long-term do-it-yourself retail investors. And so let's just proceed on today's episode. Now, for today's episode, I thought we'll cover one of the sectors that is one of my favorite sectors, which is the automobile sector. Personally, because I'm also a big auto buff, I love automobiles, especially four-wheelers, and not that I own automobiles, but I usually follow them. And I thought it'll be good to just for us to spend some time understanding how this sector has delivered returns in the past, but also more importantly, what are some of the shifts that are taking place within the industry that investors need to be aware of, and we'll sort of spend some time understanding whether it really makes sense for us retail investors to consider this sector more seriously given the current state of the market. Now, before proceeding, I do want to mention that a good business idea or a great business idea might not be a good investment idea. And I think it's important for some of the beginning investors to differentiate between the two. There are a lot of retail investors out there, and rightly so, who take a top-down view approach in terms of looking at the big picture, looking at what all are the sectors that are going to or are likely going to do well in the Indian economy going forward, and then base their investment decision based on that. I personally also happen to partially fall in that school of thought. But just because a sector is likely to do well going forward doesn't mean that it makes great investment sense. I mean, a classic example would be the airline industry, but there are many more out there. And so I just want to put that as a disclaimer right from the start. The other thing I also want to share is that this is not any recommendation by any stretch of imagination. So I'm not making any recommendations here. I'm just going to restrict my thoughts on the sector from an overall perspective. So moving on, um, you know, if you look at the uh, Nifty Auto Index for this calendar year beginning Jan 2021, it has given mixed returns in the sense overall, I think the index has given close to 10.5%. But that overall number actually covers many things. There are certain companies and players which have done quite well. There are certain which haven't done well. And so the question that retail investors, including myself, need to ask ourselves is it just market exuberance which is driving the stock price, or are there fundamental, positive tailwinds in the industry that is driving this phenomenon? And that's one important consideration to have. The second consideration is, of course, that the auto sector is more of an umbrella term in the sense there are many kinds of players in this sector. There are consumer-facing companies, predominantly four-wheeler and two-wheeler manufacturers. There are B2B companies which enable some of these consumer-facing companies like auto ancillaries. Um, there are cyclical industry dependent companies. For example, heavy commercial vehicles which supply their vehicles to, say, the construction industry. And so their fortunes or their growth is dependent a lot on how other sectors also perform. And so it, al- although we you loosely term everything as an auto sector, there are many different kind of players. So it's important to differentiate in terms of what companies we are looking at. The other consideration is that while we are going to study how these companies have performed from a stock price return perspective, they've been a factor of the valuations at the prevailing time, as well as what was the business condition like, what was the performance of the company, not just in the past, but also what was the growth outlook of the company at that given point of time. Now, these things may not repeat going forward, but past performance at best can give a good indicator. It's not something that we should follow blindly for making future decisions. However, having said that, what past performance does help us understand is how certain companies really stand out in terms of how they have been able to build a great brand or are able to command pricing power, while other companies are really net capital destroyers. They haven't been able to make great profits, or they involve a lot of capital expenditure, and they just don't generate any returns. And that's the entire intention of doing this exercise. So let's just move straight ahead. Now, there are certain trends which are obviously undergoing the industry right now, and I'm going to cover a few more important ones, but there could be many more out there. And so, if there are additional ones that you think are impacting the industry, please do share your views and thoughts on this. And I've highlighted a few, and these are not my original ideas. Of course, I do a lot of reading, and so this is something that many people might already be aware of. But um, the passenger vehicle industry is obviously undergoing a shift because of this whole COVID situation. It has fundamentally changed the way people look at ownership of vehicles. Now, the question is whether this is a sustainable shift or this is just a short-term shift is a question to ask. Going by the recent auto sales of some of the recent product launches, it might make us think that passenger or consumers are still willing to buy passenger vehicles. There's still an aspiration value in owning a desirable product like a car or a two-wheeler. However, one cannot also ignore the fact that a lot of mobility has been disrupted by these technology shifts. People are doing meetings through virtual platforms like Zoom. Companies are also encouraging virtual workforce. So the question is, are are consumers willing to invest or buy a passenger vehicle, either a four-wheeler or a two-wheeler, for commuting to office? Or is that trend going to sustain? Because a lot of work is happening from work from home. So that's one factor. Other factor is, of course, the disruption caused by the sharing economy, the likes of Uber, Ola, in a slightly different space, Quick Ride. Is that going to impact the need for consumers to own a car or a two-wheeler? The third thing to obviously keep in mind is premiumization. This is what the auto companies are betting big on, especially the consumer-facing ones. That as the middle class becomes more affluent, people will want to upgrade their vehicles, and that lies an opportunity for them to sell high-end products. Um, the fourth is, of course, a lot of the consumer buying has been enabled through financing options, so car loans, two-wheeler loans, and that trend is likely to continue. So these are some of the factors, of course, to keep in mind. The other is, of course, the government policy itself. There's this whole government push on enabling electrification of vehicles for multiple reasons, reducing pollution, reducing noise levels, phasing out old vehicles, driving more emission compliance, upgrades to BS6 and so on and so forth, and also the scrappage policy, how to periodically phase out old vehicles which are there on the road, and that will sort of act as a boost for people to put their money in buying better vehicles. And finally, there's obviously a lot of global players entering the Indian market. It's a highly competitive space, at least in the B2C segment, and so much so that there are a handful of few Indian players left in the market. But at the same time, Indian players are also venturing outside of India. Eicher Motors, Bajaj Auto, Tata Motors through JLR. They have a sizable chunk of their revenues coming from outside markets. So it's not just the performance within India that matters, it's the performance overall. And the other final thing to keep in mind is, of course, the rural demand, including demand for tractors, agriculture-based auto products, and that is also dependent on how well the rural economy is doing, how well the agriculture sector is likely to do, and so these are some of the broad factors to keep in mind. And depending on which company you are either holding in your portfolio or willing to invest, some of these things might be, influencing the performance of that company. Now, for the purpose of this episode, what I did was I looked at the 15 companies that constitute the Nifty 50 and really looked at their business performance in terms of sales performance and profit growth for the last 5 years and 3 years. And these are compounded numbers. So these are not absolute numbers. And then compared it to the stock returns that these companies have given. And this is where some of these interesting things start standing out. If I were to take the top three companies that you see on the table, Balkrishna Industries, MRF, and Maruti Suzuki, these are probably, and maybe if you want to add TVS Motors, these are probably the four companies that have given over the last 5 years a net CAGR or compounded return of more than 10%. Now, the Nifty itself has been hovering around 10, 11%. And when you look at alternate return asset classes, long-term debt funds have given again 11, 12%. It begs the question whether this industry is worth investing in. And uh, I have I have my views on it in terms of whether it makes sense to invest in these companies or not. Clearly, what one thing stands out is that there are certain players who've sort of figured out how to generate sustainable profits and revenue as compared to some of the other players. For example, if you look at Bharat Forge or Motherson Sumi or Mahindra and Mahindra, I mean, at best, these have been average performers, and the bottom of the pack, Tata Motors has really gone through a fundamental uh, shift in its, whole transformation agenda. And so far, it has been struggling to generate sustainable profits. Now, again, I'm sort of painting the spectrum broadly in terms of talking about some players which have done well in the past, some players which have struggled in the past. It may not be a reflection of what's going to happen in the future. So it becomes a case by case, stock by stock decision. But I thought this might be a useful thing to keep in mind, that maybe a handful of players actually have beaten Nifty returns and beaten, say, long-term debt fund returns. And let me just pull up the chart and, maybe let's just go through a few, chart examples ourselves. Now, what I've done is I've plotted the Nifty 50 against the Nifty Auto Index and then some of the constituting companies under the Nifty Auto Index. And as you can see, year to date, which is beginning Jan 2021, only a few companies have actually done better than the Nifty. One of them being Hero Motors, other one being Amara Raja batteries. Third one being, you know, um, is this Mahindra and Mahindra, or yeah, I think this is Mahindra and Mahindra. And rest everything else has been sort of, I would say, at par. But clearly, certain guys have not done well. Most notably Bosch. Bosch has been, and if you go back to the past return slides as well, Bosch has been just a capital destroyer so far, and looks like it continues to do the same going forward as well. Now, mind you, this is also a factor of the valuations that the company commands, and maybe Bosch has traditionally commanded a high premium because it's a MNC, and hence it hasn't delivered the kind of returns that was commensurate to the expectations. But if I stretch the graph to 5 years time frame, then the picture changes completely. What you see on the right hand side are absolute returns. These are not compounded returns. So the Nifty is given an absolute return of 73%, which would make it probably somewhere around 10% in the last 5 years. The only stock which has beaten the Nifty is MRF. Everything else has sort of been underperforming the Nifty in the last 5 years. The most obvious outlier in a negative way has been Tata Motors, which has had a degrowth of 50%. So basically, the stock price is corrected by 50% in the last 5 years, followed closely by Bosch, like I said, and everybody else has been subpar. Now, these are absolute returns, like I said. So if you compound the returns to a annualized return, then most of them will give maybe 2 to 3%, and that's what's reflected in this table as well. And so I sort of conclude this episode by saying that while the auto industry constitutes a lot of consumer facing brands, very few have actually so far figured out how to make sustainable returns for investors, despite all the fancy brands that you see in the market. So coming back to my original point, um, a good business idea is not the same as a good investment idea. It's important. I mean, the sector is going to grow. If India needs to grow, the economy is going to grow, the sector will grow. But it's important to pick the companies which not only have done well in the past, but are likely to do well in the future, given this, undergoing shifts that the industry is going through: electrification, government policy, change in consumer behavior, and so on and so forth. So that was the episode that was all about. I hope you found something useful in it. Please do subscribe to the channel. Please like the button, and thank you for your time. Have a good day.